Remember how new money is created when banks make loans? Well, when someone repays a loan, the opposite process happens and money is actually destroyed. This means it effectively disappears from the economy entirely. The reason this is so important is because it means that if we, the public, start reducing our debts by collectively borrowing less and repaying more, then the amount of money in the economy will actually start to shrink. If we all collectively reduced our debts by $1 billion, then the money supply of the economy would actually fall by $1 billion. There would be $1 billion less changing hands in the economy, facilitating economic activity. This is what tends to happen towards the end of a boom. People become so indebted that they start to try to pay down their debts. But if we significantly reduce our private debt, then the shrinkage in the money supply is likely to cause the economy to slow down or grind to a halt, making it harder for everyone to make a living and repay their debts. When people start defaulting on their loans on a large scale, this sends the financial system into crisis and pushes the economy to the brink of collapse. So, although we all think it's a good idea to get out of debt, and most of us are trying to get out of debt, as long as we continue to rely on bank money creation as such a dominant form of money creation in our economy, it will be nearly impossible to significantly reduce our collective private debt without slowing down and badly damaging the economy. So, let's see exactly how money is destroyed when a loan is repaid. Let's start with Mike, who will say owes $10,000 to Chase Bank but has spent the money, leaving his bank balance at zero. After a few months, Mike decides to pay down $1,000 of the loan. He transfers the money from a bank account with another bank to his bank account at Chase. By the way, we won't show the central bank reserves in this account because, as we saw with the clearing process, any change in the reserves would probably be canceled out by payments going in the opposite direction. So, for our purposes, we can ignore it. Now, Mike still owes $10,000 to Chase, but also has an account with Chase that now has a balance of $1,000. As a result, Chase has a liability to Mike of $1,000, which is the numbers in Mike's account balance, and Mike has a liability to Chase of $10,000, which is his loan. When Mike calls Chase and says that he wants to pay off $1,000 of the loan, all Chase does is reduce Mike's bank balance to zero and reduce the outstanding loan to $9,000. Essentially, the asset and the liability canceled out against each other. Money, the type of money that the public uses, is destroyed in the act of repaying a loan. Of course, at the same time that Mike's loan has been partly repaid, Chase might make a new loan which replaces the amount Mike paid off, in which case new money will be created and the money supply will be replenished. But if people are trying to pay down their debts because their debt burden has gotten too big, or banks are scared to lend because the economy is wavering or in recession, then the money supply of the economy will shrink. Here it is in its simplest form. If we want more money in the economy, we typically need to take on more private debt. And if we want less private debt in the economy, we will probably end up with less money in circulation, which will probably cause a recession. The only way out of this dynamic is if we pick up the slack in the money supply by creating money through public spending. This way, we can fund additional public services and infrastructure without raising taxes, or cut taxes without cutting spending, and replenish the money supply without taking on more private debt. Our Money is campaigning to change the way money is created, and we need you to get involved. Share this video, join our campaign at ourmoneyus.org/signup to stay informed of our campaign efforts, and follow us on Facebook, Instagram, and Twitter at Our Money US.